Welcome back. The NFCI, also known as the Chicago Fed's National Financial Conditions Index, is a weekly update on U.S. financial conditions in money markets, debt and equity markets, and the traditional and shadow banking systems. When the number is positive, it indicates the financial conditions are tighter than average condition, meaning more stress. Negative values indicate looser than average, meaning less stress. So negative numbers indicate better financial conditions. We can see here over the number of years the NFCI in blue versus the S&P 500. As the S&P 500 starting in 2018 rallied to the upside from 2,700 up to a level around 32. The NFCI was in at 0.5, 0.6 to the negative side, almost 0.7 to the negative side. Of course, the 2019-2020 COVID crisis, where the S&P 500 dropped dramatically from 33 down to just a little bit above 22, the NFCI spiked to a level of positive 43. Again, a positive number indicates tighter conditions in money market and shadow banking systems. S&P 500 resumed its trend to the upside. The NFCI dropped again to the negative level of negative 0.7, right around the time the S&P 500 hit very, very big historic highs, just around 4,800. Now, since then, the stock market has pulled off its highs. The NFCI has moved higher, but at the moment we can see as the S&P 500 once again marches to 4,500, the NFCI is now again negative 0.28. Again, we're not near the negative 0.7, indicating a fantastic condition, nor are we positive either. It's a mildly good situation. Here's the NFCI again in blue versus the white line, 10-year U.S. Treasury, red line, 1-year U.S. Treasury. What's interesting to note is that when we had the beginning of the inverted bond markets, this was June of 2022, when the red line, the 1-year, crossed above the white line, the 10-year, that indicated the beginning of some real financial stress in the bond markets, and that's when we saw the NFCI come up to a level of almost zero. It was negative 0.11 on September 25th. Since then, it has again come a little bit back to the downside, but since the beginning of the inverted bond market, we have not seen this number get better than negative 31. So it's only moderately better, but and I think that there is a correlation that the inverted bond market is a sign of stress within the marketplace, in the sense that the bond market's forecasting a better long-term economic outlook than in the short term. Here's the NFCI versus the 10-1 spread. Now, the 10-1 spread is the spread between the 10-year U.S. Treasury, 1-year U.S. Treasury, and we can see that as the white line goes up, it means that the 10-year bond yield is higher than the 1-year, which is normal. That's what we would expect to see. This just shows us a different way of the inverted bond market. When this white line crosses below zero, that's June of 22, that's the beginning of the inverted bond market. And the reason why we put this chart together is to show really such a strong negative correlation. As the white line goes up, the blue line or the blue area chart goes down. So this NFCI, the National Chicago Financial Stress Index, it really does track very closely with the bond market. And if we think, the NFCI it's a great source of confirmation as far as our outlook in terms of the economy. It also mirrors the bond market. So if we think financial conditions are improving, and lately we've seen some numbers look better, not the employment numbers last week, but a lot of other numbers are starting to improve, at least construction spending. Well, the NFCI doesn't say that. Things are only moderately to the positive side, and the bond market certainly does not confirm that either. Here's the NFCI versus the S&P 500. This is in 2019-2020. This is the COVID crash. Now, the S&P 500 is in white. We know we hit highs of 33.30 on January 18th. We hit very big highs of 33.86 February 19th. Now, this is 2020. This is well before, or not well before, but before we really knew what was going to happen in terms of the stock market sell-off. But notice the position of the NFCI. Things had already begun to deteriorate. We were at negative 62 on February 4th, negative 61 February 8th, negative 56 on February 16th. By the time the stock market started to go down, third week in February, the NFCI had already dropped, a couple, maybe 5, 6 basis points, 7 basis points, from 62 to 56. Now, watching this, it's not a huge change, but I think it is something, that we should, make note of. And then as the stock market really started to sell off, all of a sudden, we were in negative territory in the stock market and in positive territory. March 13th, NFCI is positive. That really reflects the amount of financial stress that's out there. So at the moment, we're going to take a look at a current chart. At the moment, we're trending on a better than, I would say, average position, but not really tremendous. And we want to see better than average, positions in order to look for confirmation of a strong stock market. On July 5th of 2020, we were at a negative 0.38. Now, of course, things are still very uncertain July of 2020, but remember the number 0.38 because this is where we are now. Right now, we're at a level of negative 0.28. Again, the deeper the number goes into negative territory, the better the economy, the better the condition, because it indicates looser financial conditions. In other words, it's easier to borrow money, it's easier for financing, there's less stress in the banking system. Well, we're at negative 0.28 right now. July of 2020, we were at 0.38 to the negative. We were in a better position July of 2020 than we are now. In fact, if you want to make the comparison, 0.31 to the negative side was where we were March 2nd of 2020. And that's after the stock market really crumbled or began to crumble. We went from 33.86 down to 29.54 in just a matter of days. We went 400 points in a couple days in the S&P 500, and the NFCI was at negative 31. Right now, we're at negative 28. So it is some cause for concern. This number is reported on a weekly basis, Friday, I believe, and we're going to keep track of this. We're not going to talk about it every week if there's no significant change, but if this indicator starts to move, we're going to be certain to talk about it because it seems to be very reactive to economic and banking conditions. We hope this has been helpful. We look forward to seeing you back soon.